Hello, welcome back to the Note. Well, we've had a calmer day's trading today after the very hectic activity we saw on Wednesday, and a lot of the positions that were taken then have been at least partially retrenched. Bond yields have gone up somewhat, the dollar has strengthened, and in the case of the S&P 500 here in the US, it's actually set a new high for the post-August correction period, beginning to look as though that really was only a correction rather than a bear market. Now, the big news we've been receiving today has been earnings, and it might seem surprising that stocks are doing well because in general the numbers we're getting out of US companies are pretty bad, particularly in the case of revenues, which are not only negative, they're declining year on year, but also below pessimistic forecasts. You saw that particularly from a range of banks who published today. Goldman Sachs in particular saw their revenues decline very drastically. However, Citibank managed to see their earnings go up a little despite a fall in revenue, and they led the sector, which was the strongest performing sector in the market. This chart here might give a hint as to what is going on and to how this has happened, the underlying dynamic. Now, the red line you see here is the earnings growth over a long period of time, and as you can see, it's now declined to almost exactly zero over the last year. In general, when you get that, it tends to signal that we are either in or approaching a recession, which nobody at the moment is predicting. You could argue that a big part of this is simply the decline in the commodities sector and oil, and that the services sector, which is much more important than it used to be, isn't directly affected by those things. But perhaps more intriguingly, look at the blue line, which is the profit margin. Usually that moves in line with earnings themselves. This time around, the profit margin continues to widen, as obviously happened with Citi today, even as earnings fall. Somehow or other, thanks to cheap credit and thanks to cuts, companies are managing to cut their way to a profit. Now, that isn't the way to a vibrant economy. It is the way to a reasonably resilient stock market. Personally, I would still feel very nervous about a stock market which is resting on a foundation where companies' revenues are falling as drastically as they are at present. But I think that explains why, at least for now, the stock market is weathering some very worrying data from US companies.